Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey, everybody, and welcome back to the Mr. R Show, brought to you by the MRR Institute. So if it's your first time here, as we like to mention in this show, congratulations. You found us here. You found a great spot for information directly tailored for you, the tax professional. So, of course, I believe I mentioned this last episode a couple times, if not more than I probably should have. You get a free CP for being here. So yes, we love things that are free. We really love things that are free, that are of quality. So we try extremely hard here to bring some information to the table for you, where you can just sit back, listen to it, enjoy it, and collect that free CPE. So if you're an overachiever, you're already collecting those as much as you can here in the new year of 2025. And, congratulations again. You found some good information. If you have some ideas for shows, obviously send them to us. We love to hear it. We have some great guests lined up coming into the second quarter. I think we're planned out for already. So we got some good ones there. But for today, we're going to look at something a little bit different than you may have expected, but we're going to dive into some post-election tax planning here on the show. So looking at it for different tax brackets. But again, this content is directly built, basically tailored for you, the tax professional. So I promise you do not want to hear me give you that information. So I brought somebody better looking and smarter to the table. Chris Picciurro, how's it going, my man? How you doing?
I'm wonderful. Happy New Year. We're in 2025 and excited to talk about the post-election tax planning opportunities. None of us have a crystal ball, although we have a good friend named Crystal Ball, believe it or not. Another podcast, completely different podcast, a teaching tax flow podcast. But however, we had this time as tax professionals that we've got tax April 15th is a big deadline for many of us. Then you've got tax extension season where you've got those S Corps and partnership returns due on September 15th. And then we've got the personal returns and the C Corp extended returns and the estates due October 15th. Then we all take a breath. We realize, holy moly, we've got the election, the very beginning of November, the election results. It's all this anticipation. And now we know what happened. We're thinking, okay, but guess what? We're already at year end, fourth quarter, and then we have Thanksgiving, and then we have the holiday season, and next thing you know, it's New Year's. And now it's like, okay, let's start thinking about planning for our clients. What do the results of the elections mean to us as tax and accounting professionals? How do we pivot forward? How do we be a resource and a shepherd for our clients to navigate things? And we'll see what happens, right? We all are. I bet if you're listening to this podcast, first of all, congratulations. You're on Santa's good list for 2025 already. If you're listening to this podcast, if you didn't get everything from Santa you wanted, you're gonna get it next year.
Hey,
But
Chris, here's a question for you. So, on the TTF podcast, if anybody listens to that we do through Teaching Tax Flow, I'm sure you'd get a kick out of some of the comments I pull out of thin air and throw them at Chris. But buddy, now that you're about to turn, a milestone in your life,
50.
right?
That's
So
all right. Just throw it out there. We
you're
don't
going
need
to
to
be a
hide.
half a century year old. But even
Yeah.
more impressive than that, you've been in this industry for a quarter century. So, and why I bring that up is, have you seen it? And, on the topic of election and taxes, without getting into too much as we get, but you dealing with clients, tons of clients over the years, different types, ages, everything. Do you in the tax world really sees it? Wow. Now I'm making up words. See it as a little bit of a recurring chaotic moment when there is an election, as far as for clients. Do you see some go into a freak out mode and just start asking a lot of random questions, or how does that
Mhm.
look for a tax pro?
Well, we don't really I'm thinking through, because I was thinking not only in my own practice. I've been very blessed to be a instructor for the National Association of Tax Professionals, where in as far as doing some live webinars and presentations, but also the tax season update courses. So these are 16 hours of live CPE in person. And this year was my second, or 24 was my second full year doing this, and I was able to do it in 5 different cities. And the point of this is that I had some of my before the election, I don't think it was a big deal because I had let's see, I had 3 no, I had 1 week before the election, then 2 weeks after. After the election, there's kind of more consensus of what we think is gonna happen, but the reason I'm bringing it up is that I was able to uh, work with and teach hundreds of tax professionals between October and December. And I love learning from them, and I love learning what their clients are asking in what they're thinking about. And it's so interesting, man. We look at things like the Corporate Transparency Act that's yo-yoed around now for for quite a bit. And what so I think that clients that are looking for tax preparation services only, and I speak for myself, but morely because mostly for as an industry, and I feel like I have a decent pulse of the industry because of being involved with not only just the NATP, but other state or CPA organizations or what have you. I would say the taxpayers that are really focused on tax preparation aren't too concerned about the election results. They feel like in general a little bit reactive with things, and they just, you know, whatever it is, it is. I'm going to turn in my documents, and if I don't like my result, now I have someone to blame, right? Where
So
the
they feel
clients
pretty
that are
comfortable going into it, unlike somebody that, comparing it to the stock market, right, where everybody's so reactionary, shooting from the hip.
Yeah, well, and with so the clients or taxpayers that are involved in tax planning and strategies, I'm a little biased in our practice because my role is tax planning and strategy. So, but when I take a step back and look at the industry in general, so our personal or our private CPA firm tax or private CPA firm clients are extremely interested in the election because part of what we do is planning and strategy. It's part of our firm membership. And so we get a lot more questions about that. Yet as an industry, I would say, there are people concerned with it, but are they gonna take action? And that's what this is about. This episode is about what happened with the election. What what are the rules? What are we looking at right now? What do we think's gonna happen? Now, you might say, "How do I know what's gonna" remember I said we don't have a crystal ball. Well, we have resources out there. I've mentioned this many times, tax actually in our other podcast, the Teaching Tax Law podcast, we had a whole episode on Vice President Harris's tax plan and former President and now President-elect Trump's tax plan. So we have an idea of what they're running on. And now, will that get passed? Well, based on the fact that the Republican Party has a majority in both chambers of Congress and in the White House, there's a higher likelihood that some of the stuff might get passed. So, if we think this is going to get passed, then okay, how do we prepare our clients for that? But I've always had the attitude that I do tax planning for taxpayers based on what I know now, not what I think might happen. Like bonus depreciation. There's a decent chance that gets back up to 100%. It's 40% right now in 2025. I'm not going to create a tax plan for a client and run numbers on cost segregation studies based on 100% bonus depreciation. Or if calculate, hey, I've got a client that's looking to purchase equipment or a new vehicle. I'm basing it on 40% bonus depreciation with the understanding that if it goes to 100%, that could be beneficial. And then if it does go to 100%, what are the things that we can do to take advantage of that?
Awesome, and I wanna say it was, like, episode 8 or 9 that we did on this show was subscribing to a better firm, and you had mentioned a little bit earlier too about, the membership that you guys offer your clients through your practice. It's not, an annual transaction. It's really that partnership that you guys have built and seen a lot of success through, and I would say and thank you again for answering that question about just people's feelings, the seasonality side of it. every 4 years. Because a couple months ago, I had a conversation with a younger gentleman who just got a CPA license, works for a very large firm, and I think he was asking me because he's a friend of a friend and then knows what we do. Um, what it's like on the private practice side. I think he was just interested in it, and you can tell he was a little weary about that. Like, oh, then I gotta deal a little bit more with personalities instead of just transactions. But I think that not to talk too much on that membership side of y'all's practice and offerings, but I think that really, you've probably seen, you could say yes or no, but you've probably seen that as a huge, huge change just in the dynamic of the relationships you guys have, where they look and trust you guys more and they don't have to freak out about, oh, well, what's going to happen? Or, oh my gosh, do I need to do something? You guys are their advocate, if you will, and their, confidant.
Exactly. So in the private CPA firm, we are for the last about 12 years, we've been exclusively membership-based subscription model. Interestingly enough, we are opening up a tax preparation only service again. So but on a personal level, that's not the division that I work in. So I'm in the tax plan. I'm on the team of tax planning and strategy. So if now someone that has been traditionally a tax preparation or tax compliance only could come over to tax planning and strategy. So for me, I'm always looking at these rules and laws, and I don't know if I had to put a percentage on it. I bet about 25 to percent to a third of taxpayers are going to actively change something they're doing based on the election results and future tax law changes. Two-thirds to 75% of the people aren't really gonna change anything that they're doing. They might be interested or aware of the rules, but are they gonna really change their behavior? Are they gonna do anything different? Are they gonna go sell their house or move to a new state or change their retirement contributions? Change their entity structure? Are they gonna do anything based on this? Probably not. It's just in my world, almost all the people I'm working with are open to changing. Or you say, look, we've got it. We set this up under the Tax Cuts and Jobs Act, your entity structure. And we feel like if that gets extended, we feel that this is a good structure. So sometimes no decision is a decision. I mean, I see a lot of taxpayers have FOMO, fear of missing out, and think like, what am I missing? Oh my gosh, am I, some isn't it a good feeling if your CPA or tax professional or enrolled agent tells you, you know what, you have structured really well right now. It's not sexy to tell someone that. It's not like you want to say, well, oh, you could do better. Sometimes you're really in it's kind of like someone that's in really good shape. Like, hey, you're in really good shape. You don't have, your body mass index is great. Your heart rate is great. Just keep on doing what you're doing. So that's the best news you could ask for, but it doesn't get you excited, right? It doesn't like, "Oh, man,
Right.
I've been trying to lose these last 10 pounds, and guess what? Now someone has a magic pill I can take, and I'm gonna lose them." So,
Right. Or somebody says, hey, you're doing great with something, but in your mind, you're your own worst enemy, where you see the what you're not and they see where you are. But let's jump into this looking at, here we are in 2025. So it is a new year. We have
yeah.
our recently reelected president coming back into office here very, very soon, with a matter of a couple days, actually. So what does this look like? And again, the best we can look at this, right? Like, we don't have that crystal ball. We're basically going off of all the information that's out there. And we have some great resources and partners that we lean on to really stay ahead of the curve with some stuff. But looking at this again, based on what's out there, what might we be looking at maybe sooner than later with some of the stuff? And again, there's a process to getting anything passed, right? It's not like whether or not I'm going to turn left or right at a traffic light. It's not solely up
Right.
to that individual. Obviously, given the way of our government setup and structure, there's checks and balances. So where's the best place to start with this in your mind?
Right, so first of all, looking at the results, like I said, the Republican Party with Donald Trump winning the White House has the is presidency. And it also has the majority in both chambers of Congress, so in the House and the Senate, which that makes potential changes. Like had the Democratic Party had still kept kept the House and the Republican Party had the other two, then you'd see some gridlock and you probably wouldn't see some major changes. So knowing that the Republican Party now for at least the next 2 years will have a majority in both chambers of Congress that makes me think, okay, let me look at what now President-elect Trump's proposals were and how that might impact things. So we're going to start off with the big one, Tax Cuts and Jobs Act, right? The Tax Cuts and Jobs Act of 2017 was a huge reform. And remember, it reduced your individual tax rates. It increased the standard deduction. It created the qualified business income deduction. And these are set to expire, after this year, with tax brackets reverting to the pre-Tax Cuts and Jobs Act levels. Now, this happened in 2018. So in 2017, when we looked at those 2017 tax rates versus 2018, so when we're looking in our software actually calculated this. Well, if we're looking at a client with a certain amount of income in 2017, that same amount of income for 95% of taxpayers, maybe even 98%, was taxed lower. There was less tax levied on the same amount of income under the Tax Cuts and Jobs Act than pre-Tax Cuts and Jobs Act for at least 95% of the tax returns that I've seen. So everyone's different. And so ultimately, the lower rates, even though they're set to expire, it seems like that might get extended. Okay, or potentially made permanent. So we've got to keep an eye on the Tax Cuts and Jobs Act expiring, and is that going to expire and we revert back to the higher tax rates, or is it going to get extended or made permanent? So taxpayers should really look at their long-term financial plans. When we're looking at lower tax rates, right? Or lower tax rates say, hey, we should consider maybe Roth IRA conversions, harvesting capital gains. In other words, when you're in that lower marginal tax rate than you might be in the future, that's the year you might want to recognize a little more income. So if the Tax Cuts and Jobs Act does expire, which I don't expect it to, well, I mean, it's going to expire, but if it doesn't get either made permanent or extended, then you've got to consider that. Because what we thought we were going to be dealing with much higher tax rates in 26 and 27. So that's something to consider, to keeping your eye on the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act reduced the corporate tax rate. So we're talking about C corporations. We don't have as many C corps as we used to, but there still are plenty of them. But the corporate tax rate was reduced from 35% to 21% under the Tax Cuts and Jobs Act. Now, President Trump I believe his tax plan called for that rate to go down to 15%. And I believe Vice President Harris was looking to increase it to 28%. So do we see lower rate for corporate on the corporate taxes? So that's your C corporations. And like I said, the Trump administration, and we are sourcing this based on a variety of sources, but our main source is going to be the taxfoundation.org, a bipartisan
They're a great
nonprofit
resource for
entity.
us.
So, well, I'm sorry.
And honestly, Chris, I love going on there and just seeing what articles that they do put out too for any tax pro that's out there. It's, their website. And yes, it is a non-paid promoted push for these guys. The information that they give out, like I mentioned, it's great. It's, as you mentioned, it's nonpartisan, obviously, but it's also very relevant to the topics that are out there. So you don't have to search really hard. So,
Right. And
um,
remember, I mean, the Republican Party does have a majority in both chambers of Congress, but they're narrow majorities. So this isn't going to be, there's still some negotiation that has to occur. So when we look at the corporate tax rates, if we see corporate tax rates go down to 15% then you might see more profits retained in corporations or in dividends paid out to shareholders. We don't know what's going to happen for our clients. If we have a client that's a C corporation and I see the that rate go down from 21% down to 15%, then it might make sense to potentially retain more income in that corp and pay the corporate tax, as opposed to shifting that income out of the corporation and not paying the 21% tax. So, and when we talk about these strategies, obviously there has to be legal and ethically tax planning done. You can't just pay random management fees to whoever you want without some type of substantiation. But let's take a look at those corporate tax rates. And again, if corporate tax rates get decreased, then you might see more C corps or more income retained within the corporation.
And you mentioned too, there's less C corps, and this is just out of personal inquiry. Is there a reason why there's more C corps now versus in the past? Is it really just the complexity of them, or they're not as necessary these days?
Right. So there's a lot less now than before for a couple of reasons. The biggest reason is C corporations are subject to double taxation. It's called. So let's say a C corporation has a profit of $100,000. Remember that rate used to be in the 30s. The corporation is going to pay tax on $100,000. And let's say right now it's a 21% tax. So the C corporation is going to pay $21,000 of tax on their $100,000 of net income. Then the C corp might pay dividends to its shareholders, right? Those dividends are taxable to the shareholder, either at their marginal tax rate, or if they've owned the stock for more than a year, that's called a qualified dividend, and they're taxed like long-term capital gains. However, when the corporation pays a dividend, that dividend is not a deduction. That's why the corporation's paying the dividend with after-tax dollars. So the higher the corporate tax rate, the less of cash available to pay dividends to the shareholders. And that's why the other reason we have less C corporations is because since C corporations have been around for much longer a period of time, we now, over the last, let's say 25 years, we have more S corporations. S corporations weren't around 30 years ago. I believe it was I'd have to look at when they came into play, but it's been at least, let's say 20, 25 years. But so now you have an S corp, which is kind of a hybrid between an LLC and a C corp. So you didn't have, and LLCs weren't around when C corps were started. So the only way you can get asset protection when you back in the day, quote unquote, is being a C corp. That's why. So now there are significant implications from changing to a C to an S corp, as we know as tax professionals. And there's something called the big tax, BIG, built-in gains tax. So if you have a C corp that elects to be taxed as an S, there are significant tax ramifications based on the retained earning in the C corp and certain assets. So like receivables and inventory and that sort of stuff. So that's why C corps were more popular, but it's kind of harder to shift out of a C corp than you can't just simply elect S status and think it's going to be easy. That makes sense without
Oh,
implications.
that's perfect. I didn't know that. I kind of assumed that it was just the structure offering had changed, but yeah, that's a little history lesson. There you go. You're getting
Yeah,
very old. You're not getting older, sir. You're getting wiser. See
I'm
this?
getting probably both, Johnny T. Probably both. So, John, I don't know if do you put salt on your pizza or
Believe it or
no?
not, my wife doesn't know how she married me because I do not like salt or sugar on anything, and she
Wow.
has a
Okay.
sweet
Well,
tooth. So,
I don't like salt on putting it on the pizza. I know some people do. I don't mind sprinkling a little salt on a. Yeah. Well, I like my you know, I've got a thing with my wife too. I love soft pretzels. They're one of my weaknesses. And I don't understand how people can eat a soft pretzel without it salted. I don't mind dipping the salted soft pretzel in mustard, but my wife loves to basically dip their soft pretzel in like nacho cheese. And my thought is,
huh? Okay.
if a good soft pretzel doesn't need to be dipped in anything, right? Why? I mean, it's good
It's like the
enough.
best
Why do you? It's like
steaks. It's like going to a really expensive steakhouse and asking for steak sauce. They look at you a little crooked-eyed, right? But
it's
I'll have to tell your wife, and she'll probably appreciate this one, and you'll probably try to punch me in the jugular. I get a soft pretzel, and I wipe all the salt off of it. So,
then why'd you get a soft pretzel? Because you get it without the salt.
sometimes they forget or it takes longer to make it. But,
Well,
yep, who knows, man?
anyway.
The
Uh,
world is made of
some people
different
out there.
people.
Yeah, we need different strokes for different folks. But the salt deduction cap is set to expire. What's salt mean? No, it's not the stuff that John, for some ungodly reason, takes off as soft pretzel. It stands for, if you're listening to this, you know it's state and local income tax. So with the Tax Cuts and Jobs Act, we saw a lot more taxpayers take the standard deduction, in part because the standard deduction was much higher, but in other part because you can only deduct up to $10,000 of state and local income tax. So someone that's in those higher tax states, like New York, New Jersey, California, where you're paying a high Illinois state income tax or property taxes, you can only deduct up to $10,000 of that, no matter how much. Um, so that's interesting. Now, President-elect Trump has signaled an openness to revisiting the cap, but that cap, if that cap was set to go away with when Tax Cuts and Jobs Act goes away. So that's what you have to consider. You've got to really look at the SALT cap deduction, right? There are some clients that we worked with on the PTET, so pass through entity tax election. So let's say you own a business and you pay a state income tax based on the profit of the business, and it's a C corp or S corp or multi-member LLC taxed as a partnership or a partnership. We know that we could potentially elect to have the entity pay the tax and get a full deduction for it. But keep an eye on the SALT tax deduction cap. If the SALT cap is lifted, itemized deductions could be more advantageous, and we might see, then you're looking at potentially deducting all of your real estate taxes and state income taxes, and potentially more people itemizing. So keep your eye on that SALT tax deduction. Another thing to consider, estate and gift tax exemption levels, right? The Tax Cuts and Jobs Act, easy for me to say, Tax Cuts and Jobs Act temporarily raised the federal estate and gift tax exemption to $11.7 million when it came out, and that's been indexed for inflation. So now it's about $13 million per person. Well, without any legislative action, the amount's going to revert to about $5 million per individual after 2025. The Trump administration has indicated that they want to keep or extend or make permanent these higher exemption levels. But that's a huge difference between 13 million and 5 million of a state tax, or for the state tax exemption. A lot of $5 million of assets is a lot of money. However, for certain people in, let's say, higher cost of living areas, when you look at the value of your primary residence, life insurance, your retirement accounts, any type of assets, including vehicles, artwork, all that's part of your gross estate. So if that gross estate, again, estate tax exemption goes from 13 million to 5 million, we're going to have a lot more people doing planning. And so right now, you're going to really, really look at that DSUE, that deceased spousal unused exemption. If you do have a client that one of the spouses passed away, you really look at that to lock that higher exemption amount in. We're going to have to keep our eye on this estate and gift tax exemption, because if this goes down to about $5 million per individual from 13 million, there's going to be a slew of people that could be potentially part of this. And another thing, John, to consider is the value of your business is part of this, right? So you might have people, when people think about estate tax, a lot of people think that, well, I don't have $5 million of cash in the bank. I understand that. It's a total asset. So you could very well have someone that owns a property. Maybe they've lived in for, 40 years, right? Maybe they live in Northern California or Napa Valley, that they have a modest home, but yet it's very valuable. It's worth $3-4 million. That's not unusual, or that's not. Maybe they have $1 million in their retirement account, and they have a life insurance policy for $1 million, and let's say they own a small business that has equipment, or they have some type of business that has some type of
Mhm.
value. So
And
estate
you mentioned
tax.
that with the businesses too. So just to make sure that I'm hearing that correct, right? Because I'm sure you guys are seeing it, little bit more often than not. But then also, I mean, I would say, and this is just a guess, in the future, decades to come, people are starting so many more businesses now. It seems, there's a lot of small business owners that own multiple businesses, and they still have a full-time job. They're getting a W-2. So there's a lot of that kind of in the mix, right? So again, to make sure that I'm hearing this right. So basically, if you own a business, I mean, taking out any other assets, home insurance policies, et cetera. Say you have a business and you have, say, $1 million in equipment. So I mean, that's, you can put a number on that. Say you have $1 million of inventory. So you got a $2 million business. If you inherit a business, and like I mentioned, say there's 2 million right there. Does anything else actually go into that valuation as far as for in a gift? I mean, like, does I guess we don't have to get too far in the weeds with it, but like intellectual property valuations, like all this other stuff, how does that work out?
Sure. Oh, yeah. I mean, whatever the business is worth is part of your gross estate. Now,
Okay.
it gets complicated, right? Because there's something called valuation discounts and that sort of thing. So let's say you own something that's super proprietary, but without you, the business isn't worth as much. That's where you have to
Mhm.
factor that in.
It's like if the key man kicks it, what's the deal,
What
right?
what if you Yeah, I mean, think about this. What if you worked at a Silicon Valley startup back in the day, you pass away, but you've got millions of dollars worth of stock options. Now that's part of your
Mhm.
estate,
Right.
right?
Okay.
There's so many. The thing is, and again, tax professionals understand this, is that your gross estate is an asset test, not a cash test. So if this state tax exemption goes down, we really got to take a look at that for a lot of people.
Right.
I mentioned bonus depreciation. Remember, Tax Cuts and Jobs Act brought bonus depreciation up to 100%, and we were able to utilize that within real estate using a cost segregation study. And it went down to 80%. It started phasing out. So now where we've got to figure out, what's going to happen with that. What's going to happen with bonus depreciation? Is it going to be completely phased out? We're in 2025, so we're at 40% right now. It went to 80% in 2023, 60% in 24, 40% in 2025, 20% in 26, and then it goes away in 27. Will the will this get reinstated? Based on what President Trump ran on, his administration aims to reinstate a full expensing of qualified capital improvements, meaning bringing depreciation, 100 bonus depreciation back to 100%. That's a big deal, especially for real estate investors utilizing their cost segregation studies. Right now, we're at 40% for 25. Now, most of the tax, as tax professionals, we're going to be working on tax returns, and for the 2024 year, meaning assets placed into service for 2024, we'll get the 60% bonus depreciation. However, there's a chance that this comes out, that this goes up to 100% retroactively. Remember, we had the HR 7024 come into play in 2024, the Tax Relief for American Families and Workers Act of 2024 that passed the House January 31st of 2024, went to the Senate and finally got kicked out of the Senate on August 1st. That bill would have retroactively made bonus depreciation 100% to 23. So I'm not predicting this. I'm just saying keep your eyes on this and see what shakes down. I think we're going to see some movement here in January of 2025.
Right. Lots of movement. It's gonna be a busy start to a new year, I think, right?
It is. I mean, we'll see what happens. Now, one of the main issues that President Trump ran on is introducing higher tariffs for imported goods to the United States. You know, when we think about, I mean, it could affect the cost of certain things. It could affect some taxpayers in a certain business. But ultimately, when we look at a personal client, in general, there's not going to be too much direct effect. Other than, again, could mean prices of things change. That's one of the, because ultimately, if we're going to cut taxes significantly, then there has to be some revenue generated somewhere else. And that's the
Mhm.
question of where can it, you know, now, how's extra revenue going to be generated? It could be via payroll taxes, right? Maybe tax rates are lower. People are employing more individuals. We just don't know what's going to happen there.
Right. Right. Yeah, because you make a very good point there, right? It's not where there's a cut, there's always a gain in some point. Usually, we should say.
Exactly. And as we kind of talk through some of these other things, like I want to jump into, you know, the other things that President Trump said that they were proposing. Let's put it that way, right? So let's take a look at that, and then we'll dive into what you should do if you're a business owner or an individual. But some of the other things we talked about: Tax Cuts and Jobs Act. We talked about restoring the bonus depreciation. Talked about making the state tax exemption higher and more permanent. But we talked about the corporate tax rate being 15% for domestic production. Interesting. He bantied about creating an itemized deduction for auto loan interest again, potentially. Also, exempting tips from income taxes, exempting social security benefits from income tax, exempting overtime pay from income tax. So, tips, overtime, social security income. Those are things that the president either hinted at or just came out and said, "Hey, these are some of the proposals we'd like." Many tax professionals, and I'm not speaking for myself, but many tax professionals, based on my experiences of spending a lot of time with hundreds of them in the winter, thought, okay, they don't feel very confident this is going to get passed. And they thought that potentially, because I remember Vice President Harris agreed on the overtime and not overtime, but the tips not being taxed. Thought this might just be a way to get some votes. This could be, but could this actually pass? But let's break these down real quick on if they did pass, right?
That would
If
probably be
exempt,
one of the hardest things ever to govern. We should say, right? It's like to
hmm
actually enforce.
yeah. So my thought is this: let's talk about Social Security benefits. This one is get a little. I know I'm kind of stumbling around, but I don't like that Social Security is taxable. You know, we didn't get it when John, let's say you were a W-2 person, I'm a W-2 person. I mean, I do receive W-2s from a couple different sources. I contribute to Social Security. I don't get a deduction for that. So I don't know why I should have to pay tax on the benefits. But that's just the way it is. Now, the employer match is is a deduction for the company. So I can see the way I'm looking at it is the maximum tax on Social Security should be 50% max. But I don't know how we're going, if Social Security benefits became not taxed, I mean, and let's say it's temporary, that would spur many people to start taking money out of the retirement accounts in those years because right now we know that Social Security benefits are taxable based on your income. And so for many people that have a pension or have required minimum distributions, they're paying an 85% tax on those Social Security benefits. So that one there, um, when we look at the Social Security and some of the concerns about it funding, I don't know what the relevancy is, or I don't know what the chance that that actually occurs is. Probably not the best.
Right. Right.
Exempting tips from income tax. Now, I see a couple things going on here that had bipartisan support. You could consider a tip a gift. So you can theoretically, John, let's say you're, you're delivering pizza. We're going back to pizzas, right? You're delivering pizzas and you get tipped. I could see in theory someone saying, well, that's just a gift. Now, I think that it's in relation to the work that you're doing. So I do think it's some type of wage. But why would the government say we're going to exempt tips from income tax? Probably because they realize that not too many people are paying tax on those tips unless it went through a
Right.
credit
Right.
card.
And I can't remember if it was one of the episodes here on the MRR show, if it was one of the teaching tax flow ones we did where we talked about this. I think it was one of the TTF ones that we kind of analyzed, the proposed tax plans from either candidate. And I can't remember if it was myself or you or somebody that was on with us where brought up, it's pretty much any QuickBooks. QuickBooks Online, I think, has done a really simple job of doing it to where you can invoice for a service. You could be a plumber, you could be anything. You could send an invoice for $1 and then, you could add the tip column in there. I know there's some other platforms. Honeybook, I think, is another one. A lot of these online invoicing ones where they give that option to activate, quote unquote, activate the tipping section on there. So you could always go into a house and say, listen, I'll give you a little bit of a discount I'm going to invoice you for $100. It's a $10,000 job, and just give me a 9,000, 9,000 something
Right. There, so
tip.
that would be tough to manage, like you're saying. What
Right.
disguising tips for legitimate compensation, and should people at least get paid the minimum wage? And gosh, there's a lot of things. Is it give report on a W-2? Can someone deduct the tip if you're not paying tax
Exactly.
on it? And then overtime.
Exactly.
Exempting overtime from tax is another interesting thought. And I'm just thinking about how complicated those W-2s are going to be. How it's going to be a really difficult. And when it says exempting overtime pay from income tax, I still think that tips would be subject to Social Security and Medicare tax and unemployment tax. It didn't. So there's just a whole. I don't want to get down in the weeds too much about what's the ifs and buts and with this, but we've got to really look at is that going to occur? Is that
Mhm.
gonna happen? So we'll have to see. Now.
Yeah, it'd be tough. A lot of it, again, yeah, we're just basing it off of what's been proposed, right? That's the best leg we have to stand on at the moment.
Exactly. That's the key. Well, okay, so let's talk about individual taxpayers. Like, given the expected law changes or kind of the tea leaves, what if you're an individual, what should you be considering? We know under Tax Cuts and Jobs Act, I've been saying for many, many years now, taxes are on sale. And if the Tax Cuts and Jobs Act is set to expire, I really would consider those Roth conversions, either backdoor or just straight up Roth conversions, right? Because either so when we're in that lower tax rate environment, the Roth conversions make more sense. I mean, that's just the way it is. So if you're an individual taxpayer, that's something to consider. We do a ton of Roth conversion analysis for clients to try to keep them. I mean, there's a ton of people that maybe they're in their early retirement. We want to keep them in that 12% marginal tax bracket by doing Roth conversions if the situation's correct. So charitable contributions. Remember I said the standard deduction's a little higher now with Tax Cuts and Jobs Act? If the standard deduction stays higher, that's where you might want to consider bunching your deduction. So let's say you're right on that cusp of, do I itemize or do I take the standard deduction? And maybe you're charitable. Maybe you donate $10,000 a year to charity. And if you donate the $10,000 a year, you're still getting the standard deduction. You might want to donate a little less in one year, and then like every even year you donate $20,000. And then every odd year you might not donate as much. Something like that. Same with property taxes. You could, when we didn't have the SALT limits, you would do the same thing with bunching deductions. So bunching charitable deductions or using donor advised funds could really be beneficial. Donor advised funds is nice because you don't have to distribute all the money to charities the year you make the contribution. And most financial advisors do offer donor advised funds. That way, hey, I want to let's say I'm earmarking $50,000 as a charitable contribution for this year. I don't want to, it's December 28th. I don't want to decide, hey, my wedding anniversary. I don't want to decide what charities they go to at the second. So I'm going to put it in a donor advised funds and take that deduction this year and then make sure that we follow the rules and get that distributed.
Mhm. Absolutely.
But, oh, go ahead. I'm sorry.
No, 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 you're good, man. Go for it.
Yeah, 529 plans. I mean, with the 529 plans, there's been some tax law changes where we can now use them for K to 12 private or parochial schools. We can now, you could always change a beneficiary. You can convert them up to $35,000 into a Roth IRA down the road. If there's certain rules you have to hit, as far as it has to be an account for 15 years. But the point is, 529 plans are much more flexible than they used to be, and they can provide you with tax-free income and growth. So that might be something to consider as an individual taxpayer because we're in a lower marginal tax rate right now. Getting that tax-free growth, if we think tax rates are going to be higher in the future, could be more beneficial. And then state and gift tax, right? I mean, if this, it's set to go down to about $5 million. That's 40% approximately of what the current estate tax is. That's significant. So planning for that, for people that have businesses and any type of assets, significant assets, because the estate tax could be up to 50% of the amount above that. So I think a lot more proactive planning might occur with, you know, if we think that exemption is going to go down, we've got to take advantage of these high exemption levels right now. So this might be the time, if you do have appreciated assets, also to move them out of your name and into maybe a family trust. Now, work with an estate planning attorney. Don't just do this on your own. But let me give you an example, John. Let's say we know you like cars, right? What's your favorite car? Like, what I know you have some family history in General Motors, specifically with Corvettes. So, what's like the most valuable Corvette you could imagine?
Oh, as bad as it is, I don't even follow Corvettes anymore.
Oh, I'm
Um,
sorry.
well,
None like
you know
throwing
what we'll do is we'll just pick a car. We're gonna say an original AC Cobra, so a Shelby Cobra, an
Okay.
original now, so millions of dollars.
Million. Okay, let's say, John, for some reason you've inherited that many years ago. You've had it in your garage. You've got it insured, and it's worth like 5 million bucks. I'm just gonna okay, and you don't want to. A car might be not a great example, but let's say you bought. Okay, let's say you had stock.
Mhm.
Let's say you
Or
worked
even a building.
somewhere.
Let's say I inherited a commercial building.
Sure,
Is
yeah,
that a
you
better one?
inherited a commercial building, and it's worth a lot more money now, and let's say it's worth $5 million, and you're like, well, if I pass away, it's going to be subject to estate tax, once Tax Cuts and Jobs Act goes away. But I have a huge gift tax exemption right now, and I'm willing to use some of it. That's where you might want to move that building into some type of trust. Now, if you're listening to this and you're walking, jogging, driving, you might be flying off the road saying, this CPA doesn't know what the heck he's talking about. We don't want to I know we don't want to lose our step up in basis. We're talking about a very advanced strategy where maybe John puts it into some type of grant or retain trust where he could still or family limited partnership where he could still get the income from it while he's alive. Maybe there's a way to preserve the basis step up. But the point is, right now might be the time to get assets out of your name and you use up this higher exemption level of estate and gift tax. So those are just those are the things to consider. Now, your business, we're going to talk about business owners, and then we're going to talk about real estate investors. Business owners, you could, I said bonus depreciation is only 40%. And I say only in quotes, quote unquote, right? That's still very generous. But remember, if it's reinstated, that's going to make it more advantageous to invest in fixed assets. But even at 40%, that's not terrible. If corporate tax rates change, remember, John, I mentioned you might want to reassess how your entities are structured, right? You might want to maybe retain more income in your C corporation. You might want to think about now. Remember, we got the Section 199A deduction, qualified business income deduction, Section 199A. That that we're going to have to see what happens with that deduction, right? Because that if that gets continued on, then we've got to look at S corp, C corps. But the point is, we'll have to see if the C corp tax rate is significantly reduced. You might see LLC. So, John, just saying, you could be an LLC and elect to be taxed as a C corp, and now you're C corp moving forward. There really aren't too many tax implications for that immediately. In general, that hasn't been very attractive based on corporate tax rates, but that might become more attractive. Keep your eye on research and development tax credits. There's been a lot of activity with policy changes, and there might be a lot more businesses that have R&D tax credit availability where we didn't before. And especially with the Secure 2.0 Act, there's been a lot of changes to IRA contributions, retirement contributions, and who's eligible for. So if you're a business owner and you have employees, you want to focus on what could we do? How can we give people tax-free benefits within your team? Now, you might not have any employee. You might be the only employee, or you and your spouse are the only employee. But look at those. How can a business get a deduction and provide an employee with a benefit without having to with it being a deduction for the business and the employee not having to pay tax. That's a tax-free fringe benefit. So that could be a health savings account, retirement plan contributions. It could be an accountable plan for home office, That could be an accountable plan for mileage reimbursement. So if you're a business owner, again, think about where you're at right now. Think about what we think is going to happen down the road, and should you restructure? I wouldn't make you know, a knee-jerk reaction, but talk to your tax professional. Now, real estate investors, we had a whole episode on cost segregation studies, right? Cost segregation studies, even at 40% bonus depreciation, could still be extremely advantageous for you. Remember, if you bought an asset in 2020, for instance, and you do your cost segregation study for your 2024 return, you still get the 100% bonus depreciation. The bonus depreciation percentage is based on the year the asset's placed into service. So tax pros, just because the bonus depreciation is at 40% doesn't mean cost studies are gone. Really look at potential cost segregation studies. Man, John, I can't tell you how many. We had Engineer Tax Service, Heidi Henderson from Engineer Tax Service on this podcast. I gave a lot of tax professionals their information when I was working on those tax season updates, because we talked a lot about something called Form 3115, and that's how you do a change of accounting method based on a change of depreciation schedule. And cost segregation studies are still really attractive, even at 40%. They're even more attractive at 100% bonus depreciation. So keep your eye on the bonus depreciation if you have clients that are real estate investors. 1031 exchanges are still out there and still available. So if you have real estate investors that are looking to defer that gain, I was out this morning playing a certain sport that I will not mention, and a friend of mine came up to me and said, "Hey, I talked to you a few months ago about a 1031 exchange." Honestly, I didn't remember talking about the 1031 exchange, but people just ask me random tax questions. He's like, I've got this property under contract, and now I'm thinking about doing the exchange. I don't need the money. I'm sick of being a landlord. He bought a commercial building in I believe in Nashville many years ago. So for someone like that, the 1031 exchange is still in play. It's still a great opportunity for some people. The qualified opportunity zone funds are still in play. And make sure that you're looking at the interest rates too. Like, because interest rates are going to affect in many ways the price of properties, which could affect the 1031 exchanges. So yeah, what we're looking at is, let's see, the 2024 election results, I think, are going to have some changes on our tax policy. I think that's it seems like the tea leaves are saying the Tax Cuts and Jobs Act provisions will get extended. And I know if you're listening to this, you're very, very familiar with that. So I think another theme is going to be the reduction of corporate tax rates. That seems to be imminent. And we'll have to keep our eye for individuals on that SALT cap. Right now we have a lot less people itemizing their deductions, but if the SALT cap gets lifted, then we're going to have a lot of people itemizing again. So we're going to have to see how this shakes down. And, I'd say for 2024, we know what those rules are. Let's get through tax filing season and really keep your eye on in the next couple months of what's going to happen with these tax laws.
Absolutely. So just like the salt shaker, things will shake out in play, right? There's my dad joke of the day. That's the best. That's the best one I could come up with. But awesome, Chris. Well, it was great to run through this again, just to kind of reiterate to everybody, all this, this conversation is based off of the information that we're provided, have access to. As you know, things will most likely take place in some way, shape, or form, where things may go one way or the other, and we'll see how things go. So I look forward to kind of recapping this a little bit here down the road and seeing where things come out. I know, the next episode that we're going to do here next month on the Mr. R Show, we're going to look at something totally different than this. We're actually going to look into implementing financial planning into a tax practice. So the great thing about why I bring that up now as well is a lot of what's going to happen here. I'm sure that your clients as a tax pro are going to come to you with, well, what can I do? What does the future hold? And of course, you don't have that crystal ball. If you do, please share with us and everybody around you. You'll become a billionaire. But incorporating something such as financial planning in there really gives you, and Chris, you can attest to this, right? It gives you a more of an edge and more of a relationship value, if you will. Is that probably the best way to put it?
Absolutely. And I think that having those longer term relationships with your clients is really important. Being in, I guess my advice would be also don't feel like none of us know what's going to happen. Don't put that burden on yourself. Let's just monitor it. I would look at monitortaxfoundation.org. It seems like what's happening is, and let's look at, our tips going to become tax free? Is overtime going to be tax free? And are we, it seems like a, a, we have to understand the process, right? For something becoming a law, it has to go through both chambers of the Senate, and there's committees involved in writing these laws. And I think that the sentiment is that instead of that the sentiment is, hey, let's put together one bill that's going to really change the landscape of things instead of all these little different tax law changes. And I anticipate something like that is going to come through in the next month or so. And we're recording this in the very beginning of January, to be clear. This could be, who knows what's going to happen, but
Things could change by tomorrow. So
absolutely.
we roll with the punches. But yeah, thanks for everybody for joining us. Thanks, Chris, for running through this with us. And again, we'll touch base on some of this content as things come into play. So we look forward to future episodes. Again, any ideas that you guys or topics that you may want to hear us discuss on the show, or potentially even be a guest with us, we'd love to hear from you. That's why we are here. That's where we built our masterminds around. Everything that we do through the MRR Institute is specifically and tailored for tax pros such as yourself. So until next time, we'll see you back here again on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.